I'd like to call the November 17th, 2025 Oklahoma City Maps Investment Operating Trust to order. We've got item number 2 is to approve the minutes from our August 18th, 2025 meeting. Have a little technical difficulty here. And it passes unanimously. Now we're to item 3, is to receive the general manager report for the period ending October 31st, 2025. We have City Treasurer Matt Boggs with us. Matt?
Good morning. So with a trust like this that has at least 40-year horizon that we're looking at, a lot of the things that we're doing is towards the future. And as I was reviewing the general manager report as we were prepping for this meeting, I thought this is a perfect example of that, because this report will be extremely useful in about 10 years when a lot of the projects are going in and out. Right now, it looks like we're regurgitating the investment report. To some extent, it is. So I will not spend too much time because I don't want to steal Doug's thunder as he talks about what's been another good quarter, because we're sitting at just under, so at $149.3 million. Just to think where we were compared to that a few years ago, it's fantastic. So really the only changes between this and our previous quarter's report will be the market value, but also we have had one additional allocation. The beautification, they submitted their funds for the position that they're funding through the beautification piece. And so those are really the only changes we've got between last quarter and this quarter. But I would also like to say, with the increase in the market value, that truly is a testament to the investment consultant strategy and you adopting that strategy and your leadership with that. So can continue on with that. So any questions you might have?
Passes unanimously. Now we're to item 3B, receive the quarterly investment report through September 30, 2025. Doug Anderson with Mariners here today. Welcome, Doug.
Good morning, everyone. Exactly what Matt just said. Things have been good so far. If we would, am I driving this? Okay. We'll go quickly over market environment. The third quarter, we saw the Federal Reserve reduce rates. We saw that happen in October, and it looks kind of 50-50 whether the Federal Reserve is going to cut in December. That's kind of something that's happening. The impact of the tariffs, which was big earlier on this year, and the impact of the government shutdown have seemed to recede quite a bit, and we're seeing good growth as far as third quarter earnings in corporate America. Some things that have changed on page 3 here, you see that quarterly performance, that's for the quarter on the top chart on the left-hand side. So the S&P was up 8%, and then you see small caps at 12.4%. So we are seeing some rotation both into and out of what is called the Mag 8 now. It was the Magnificent 7, now it's the Magnificent 8, the big tech companies there. But we're also seeing some benefits of investing in small caps, and then also in international equity, because we do have a decent allocation to that. Looking back over the past 1 year, these are all figures as of September 30th. You can see that it definitely did favor the large caps there, with the S&P up 17.6, mid caps at 11%, which is still a great return, especially since we're trying to earn 4% or better per year, and then the Russell 2000 small caps at 10.8. International equities have done very, very well for the first time in about 15 years, so we are getting good results out of that. And then fixed income, our stabilizing assets there, you can see that the returns over the trailing year are positive. They're less than the coupons because we did see some rate rises throughout the year. And then you see our so-called risk-free asset, 3-month T-bill or money market funds at 4.4%. So I'll come back to that in just a moment. Growth outperforming value over the last year, and again, that's the Magnificent 7 or 8, however you choose to look at it. And this is as of September 30th, the largest companies in the Russell 1000, and then the largest companies in the Russell 2000 on the right-hand side. So looking at the weights of the 10 largest companies in the Russell 1000, this is a cap-weighted index. So shares outstanding times the market price of each share gives you the total capitalization of a company, and that's how they are weighted. If we look at NVIDIA, again, 2 years ago, NVIDIA was making chips for gaming consoles. Now they can't produce enough chips for the AI data centers, and you can see that they have risen. They were the first $4 billion market cap company earlier this year, and now they are the first $4 trillion market cap company earlier this year, and now they're at $5 trillion. So for the trailing 1-year return, the largest market cap company in the United States was up 53.7%. And again, lots of talk about AI. Is it a bubble? Is it a build out? Is it too good to be true? It's said. All those things are being said right now. But the good thing for NVIDIA is that they are central to the AI build out. Their chips are. No one has come up with an alternative chipset or architecture that can compete with them when it comes to that. After that, you see Microsoft, Apple, Amazon, Meta, Broadcom. You can see over the last year, they are part of the AI build out, up 93%. So now we're calling it the Magnificent 8 because they have gotten so big. And you have to go all the way down to Berkshire Hathaway before you get something that's not technology or technology adjacent. Getting down to Berkshire Hathaway, but I believe last week that they bought something like, I think it was 8 million shares of Google last week. So you can see where this is all going. Now, I do want to go over to the right-hand side to talk about the small cap, saying that we did have some good results in small cap. But when we're looking at the names there, these are sort of supporting or vendors to the big companies there. So Credo Technology, Bloom Energy, and then go down to a company that I follow just out of fun almost, Oklo, which is a small modular nuclear reactor company. I don't know if you've read about this or heard about it, but nuclear power is supposedly going to save the grid in the United States, and they are one of the leading providers. They have small modular nuclear reactors, which is basically a very nice looking freight container sort of type thing. It's modular. You can put it there. It can put it in a middle of a parking lot, basically, and produce. It's not gigawatt power. It's megawatts. So it is a speculative company right now. But the interesting thing about that is that they run a nuclear reactor variant that is sodium cooled. And it sounds like it's new and next wave technology, but the Energy Department has been running a test bed of this type of nuclear reactor in Idaho for about the past 70 years. So it's tried and true technology, but this is just trying to integrate that into the greater power infrastructure, which is an interesting place right now. So moving on to international equities, you can see over the last quarter, US dollar returns were lower than local currency returns. That means that the dollar actually has reversed course. It was moving lower versus foreign currencies after the tariff announcements, but now it has moved the other direction. But those returns are great, and not something that we're used to seeing international equity providing returns that is close to equal or even greater than US equity returns. And then going into the more stable part of the portfolio, fixed income, again, the returns for the quarter and the year are looking good, and you're seeing some risk, some benefit for taking risk in the portfolio. So high yield, those are junk bonds, publicly traded, up 7.4%, outperforming everything else. This is the greater fixed income universe has changed a lot in the last 10 years. So it used to be mostly publicly traded. Now there's a lot of private debt. And private debt is part of the private equity infrastructure. And over the last couple of weeks, we've seen some defaults in private debt. We don't have investments in that area here. We're very cautious on how we do that. But I think that we're going to see the after effects of a lot of competition to fund companies out there. And I think that we did definitely see some deterioration in credit standards and underwriting. So we may see some more stories about the fixed income world, but mostly on the private side. The average credit quality of the public markets has actually increased over the past 10 years, and even on the high yield or the below investment grade world, that part of the market has actually improved in credit quality or the ability for the borrowers to pay off their public debt. So yield curve continues to be a little bit interesting here. You can see the gray area is the most recent. You can see that we have a real dip in the curve here, and then there is still, this feels interminable almost, that we have had a yield curve that has not been, shaped as traditionally. Traditionally, there would not be this concave area of maturities in here as far as the yield curve goes. And up to the top here, you can see that the Fed funds rate has declined since September of 2024 over the past year. And this does not show the October cut in Fed funds rate. And remember, Fed funds is sort of the cost of capital in the world. And so when we see economic slowdown, the Federal Reserve will cut Fed funds rate to make it, to stimulate the economy. But so far, so good. And one of the things that we can say we noticed during the government shutdown is that the government provides, federal government provides a lot of labor statistics, a lot of inflation statistics. And so we were sort of grappling in the dark as far, because those were not being released. There is some public market or some privately produced data on that, and it's become more interesting and evolving as we move forward. Maybe it's more accurate, maybe it's not. So going to the portfolio here, I think this is a picture we should all be very grateful and thankful for. You can see that since the early days where we were a little bit concerned there, the gray area is the net cash flow or principal. In other words, the blue line is the market value. And I think back to this a lot. We started this at one of the very most difficult periods of time. It was almost to the day of the uncertainty that we've been under since the Russian invasion of Ukraine, and we hit that a couple of days afterwards. But we have slowly and gradually made our way to a nice surplus here. $37 million, is that by your figure? 33. Well, there it is in the gain-loss figure right here. So total return since that time is 27.69%. That's a cumulative rate of return. Here is the market value. And you'll notice that we did take a time out. We took a time out very early on, and we de-risked the portfolio for a couple of quarters, and then we went back to our target asset allocation. Remember, we feel, as investors, we feel risk in days, weeks, and months, but we compound returns over quarters, years, and decades. And this is a 40-year lifeline, or the 40-year life expectancy for this fund. And so we're able to absorb some of this short-term risk. And I'm going to move on to asset allocation in a few pages. I'm not going to suggest any changes, but as we get towards the end of the year, we do have an ample cash balance. You see $4 million. That is much more than we expect to pay out this year, and possibly what we may pay out next year. And we're trying to guard that against market volatility, but not take too much away from the rest of the portfolio. And also remember, a few pages before, cash outperformed bonds over the last year. So holding that cash as a substitute for fixed income or bonds didn't really hurt us. And I think that I would still, until rates get much lower, maintain that position of de-risking that part of the portfolio. So looking at this slide, you can see where our largest allocations are. Our largest single allocation is the Dodge & Cox Income Fund, $50 million, 34%. Second largest is going to be the Fidelity 500 Index Fund, and then we have the mid-cap and small-cap portfolios, international equity at 8.7%, and then the rest of the fixed income portfolio at 5.6%. One of the things I like about this portfolio is that it is very inexpensive. We have kept a very close eye on costs, and that is evident by the index funds, and we do have some active management, but it's on the fixed income side. As we look on this slide here, you can see that for the short run here, we had the fixed income composite was slightly above target. I think as we move into year end, it's probably a good idea to take another look at this. I don't think we're going to be funding alternatives or real estate in the next year. Real estate continues to be a perilous marketplace, except for maybe where we are. When you're looking at the changes that have happened because of work from home, because of overbuilding in some areas, I still don't think that we have seen the bottom of the real estate market. We look at it constantly. Maybe something to go into that area would be infrastructure. Infrastructure is just another word for highways, for pipelines, for more stable versions of assets that are very well collateralized and also critical to the functioning of our economic world. Looking at this slide, during the quarter, you can see there was a distribution, $328,000. Income off of the assets was $903,000, and appreciation was $6.2 million. So that's how we get the change from $141 to $148 million during the quarter. That's a great quarter for us. And if we look over the trailing year, total distributions $478 versus income of almost $4 million and appreciation of $9.6 million. And again, most of that's coming from the equity part of the portfolio. Now looking at the total fund, so for the quarter, third quarter, 5.08%. That's a great result, and you can see it came from equities and fixed income. Year to date, calendar year to date, 11.19, 1 year return, 10.09, 3 years, 14.42, and that's an annualized rate of return. And the inception rate of return, again, compound annualized rate of return has really started to rise. 6.91%. As we go down the 1 year column, you can see the returns of the index funds versus their benchmarks, and they are spot on. These are net of fees. As we look into the international equity over the trailing year, kept pace with the S&P 500. If we look at the year-to-date period, it's almost doubled the return of the S&P 500, which is, I think, something we're all glad to see. And as we go down for the 1 year rate of return for Dodge & Cox, outperformed its benchmark, ranked in the 19th percentile, and the PGIM High Yield Fund 7.52. So really, the portfolio is performing. The index funds tracking perfectly. The actively managed funds, it's doing very well also, and that's almost 40% of the portfolio. When we look at on the right-hand side, so this is since inception, and this is since inception of the funds themselves, not their inclusion in the portfolio. And just looking at, going back to 2011, the S&P 500 index fund is 13.94% annualized. And this is rated versus, or ranked versus other funds in the large blend index or universe, so active and passive. By investing in the index fund, you outperformed 91% of the other managers in that area. That's fantastic. Looking over for our mid cap and our small cap, again, there's debate whether you should be actively or passively managed in these areas. I don't think that we need to talk too much about that. The passive allocation to mid cap and small cap is working fantastically well. And then as we go to the international equities, maybe some debate there, but I think that the structure is working very well. And then going down to our fixed income managers here, since 1989, the Dodge & Cox Fund has outperformed its benchmark and ranked in the first percentile. You can't do much better than that. And the PGIM High Yield Fund at 25th percentile. I think I'm perfectly okay with that too. I do want to go to, unless there are any questions about any of the individual funds or how we're allocated, I do want to go to this slide right here. This is the fees and expenses, investment management. Your total, at the total portfolio level, 19 basis points. This is very, very low. And a lot of that is because our equities are all indexed. And again, I think that's the right place to be right now. Our fixed income, again, this is a little bit unusual. Your fixed income portfolio, the fees are, or the expense ratios are actually higher. But that's because these are actively managed portfolios. The returns that we showed are after fees. So they're by far exceeding expectation here. And again, it's not a huge part of the portfolio. Moving forward, I want to make sure that we have reasonable expectations. The markets have been fantastic the last 3 years. Equities have done about double what we normally expect them to. As far as risk control, I want to make sure that we do have the next couple of years expected cash flow. I would like to see that remain in cash and kept free of market volatility. And as far as taking cash flows or rebalancing the portfolio, I don't think we're going to be allocating to those alternative real estate in the next year. I think we're doing just fine in liquid, cheap assets out there. And I think that we probably will be coming to you, or Matt and I will be working on making sure that the portfolio is at its targets, right? If equity continues to grow, we want to take profits and reinvest it in lower risk asset classes. That's our long-term risk control. But again, I know if you're watching the markets every day and you're seeing, bless our hearts if we watch CNBC, because it's just, all terror all the time. Just step away from it. And remember, we do feel risk and we feel return on different wavelengths. And we feel risk on days and weeks and months, but we compound over years and decades. So with that, nothing further. The portfolio is working tremendously well. We appreciate your business very much and look forward and have any questions?
Okay, any questions for Doug?
I have one. I know that we were going to review the investment policy.
Yes.
Has that taken place, or is that in the works?
It has not taken place yet. It's really good shape, but probably should have a sign off at our next meeting.
Okay.
And again, I want to keep the opportunity to, at some point in the future, invest in real estate and the other assets. I don't want to write it out of the policy, but I want to give us a way that we can allocate to that if it is attractive on a risk-return basis. Real estate is a mess, and I think it will continue to be a mess until some really hard marks to market happen. You hear about these buildings, Class A office buildings in Denver, San Francisco, wherever, where the last time they changed hands, it was, $160 million transaction, and the bids that they're getting for these buildings are $20 or $30 million. And until that resolves itself, I don't want to be putting capital there.
Doug, in another board that I serve on, we actually thought about this deeply, and we actually liquidated most of our real estate holdings and put them into public equities, large cap mainly, for this very reason. So, I think it's worth an analysis to look through that.
Yes.
Because to your point, the objective of real estate is to diversify the portfolio. But if you're not getting that, then it makes sense to get out of it.
Yeah, it does seem like it's a lot of, it seems like it's return-free risk to me, not risk-free return. It seems like there has to be some rationalization. And a large part of that market is private, right? So we don't see daily marks to market. And until those portfolios are liquidated, they're going to be held at marks that are higher than reality.
But I guess to Bob's point, does that mean that we do need to revisit the investment policy in order to make that adjustment?
I don't see us investing in real estate in the next 3 years. I don't really see us allocating to real estate in the next 3 years unless something extreme happens. In the past, there have been opportunities to allocate to asset classes once they get really displaced, but real estate hasn't gone through that cycle yet. And I would have thought we would be there by now. Maybe that deserves some conversations with investment committee.
I think what I'm hearing is your recommendation is to leave the investment policy with some flexibility.
Yes.
But I think what Kevin and Bob are saying is let's talk about it. Let's
Absolutely.
talk about that. Did I paraphrase correctly? Okay. Okay. Any other questions for Doug? Okay. Thank you. So with that, I'd take a motion and a second to receive the quarterly report ending September 30th. Okay, the motion passes. Thank you.
Thank you.
Item 3C, the monthly investment report, and I think only October is what we need.
This is October 31, so not a lot different. You can see market value did increase a little bit. Market value is the same, positive for the month slightly, and you can see that our trailing year is up to 13%. And again, nothing really new to add except for we compounded a little bit more on the portfolio.
Okay, any questions about October? Okay, take a motion in a second. Thank you, Doug. Okay, motion passes. Item 3D, renewal number 4 of custody account agreement with BOK Custody Services for an estimated cost of $55,000 retroactive to November 15th through, November 15th, 2025 through November 14th of 2026. Okay, the motion passes. Thank you. Item 3E, receive calendar year 2026 meeting schedule. You see it there. Well, no, they don't have this.
Yeah, it's just attached.
Okay, that's an attachment. So has everybody seen that? February 16th, May 18th, August 17th, and November 16th. Okay? All right. Thank you. Motion passes. Item 3F, ratify claims for the period ending September 16th, 2025. We have 3 claims totaling $29,837. They were for auditing services, custody bank, and investment consultant. Any questions? Okay. Okay, the motion passes. Item 4, comments from trustees, staff, and interested parties. I don't think we have any interested parties here today. Anything from the trustees? Okay, staff? Okay, the only thing I'd like to say is this is the last time that this group will get together this calendar year, so wishing everybody happy holidays and a wonderful new year, and we will see you February 16th. Okay, with that, we are adjourned.